Hey everybody, it's Nico Argyris with OneFin Realty Group, and I wanted to put this quick video together this morning, just basically in putting some context around this whole rate hike that we've been hearing about from the Fed. So today, just about an hour ago, the Federal Reserve convened a meeting to talk about this much anticipated rate increase that we were hearing about in the media over and over again for quite some time now. So what I wanted to do is put some context around what this really means for the real estate industry and more particularly for mortgage rates. So the reality is that the Fed did meet this morning at 11 o'clock Pacific time, and they decided to raise rates by 0.25%, which was highly anticipated and transmitted through the market. So the one thing that's not obvious is that the federal funds rate has really nothing to do with mortgage interest rates. And so there's a lot of panic in the marketplace thinking that just because the Fed is raising their rates, that it translates directly one-to-one to mortgage interest rates. So just a little background on it. The federal funds rate is the rate at which banks charge each other for borrowing overnight. So it's kind of like a insider thing between banks only. So the effect of this as it translates into the mortgage market is negligible. The difference is that typically when the Fed is raising rates, it's because they anticipate an increase in the economy. So the economy is showing some strength, and therefore they're looking at trying to hedge for inflation. Now, mortgage interest rates traditionally do not follow in suit. There's no correlation between the federal funds rate increasing and mortgage interest rates. However, the mortgage interest rates are more affected directly by what's happening on Wall Street. So the secondary market and mortgage-backed securities are really what fuels the changes, the ups and the downs in the mortgage market. So if we look at this and we pull back in context, what does this really mean for the marketplace? Well, it's more of a psychological issue most of the time here with this rate increase. And what I mean by that in more context is for buyers who have been out there thinking about, they've been on the fence about making a purchase, a lot of times the rate increase will cause them to jump basically and to make a decision and make a purchase for fear of potentially higher interest rates or even higher interest rates coming in the future. So that's one component. There is another component that's interesting, and that is for cautious buyers who have been out there, they may be just on the brink. Let's say that they're just barely qualifying to make a purchase, and the thought of higher interest rates might cause them to take pause and actually to withdraw themselves from the process. So there's all kinds of psychological elements that go into it. But as far as a direct one-to-one, there is no correlation between this 25 basis points increase in the federal funds rate and the mortgage interest rates. So I hope that helps to put this in context. There's no fear. We've been in a market. In fact, the federal funds rate has been at zero for nearly 9 years now. And so this is a result in trying to prop up an economy and making sure we're getting back on our feet. But we've made mortgage interest loans, not we, but there had been mortgage interest loans made with federal funds rates in the 5% range, 10% range, and it hasn't stifled the economy or the home buying process. So not to fear, all is well, but just know that the federal funds rate is a rate charged between banks overnight and has no correlation to mortgage interest rates. If you need any more context around this, or you want to talk about how interest rates might be affected in the long run, please feel free to reach out to us and we'll put you together with one of our preferred lenders who we can answer all your questions. Thanks very much.